Q2FY26 Investors Conference Call, hosted by Axis Capital Limited. This conference may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risk and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. Now, I hand the conference over to Mr. Praveen Agarwal from Axis Capital Limited. Thank you, and over to you, sir.
Thank you, Swapnali. Good day, everyone, and welcome to this earnings call of LIC Housing Finance. Today with us, we have the management team led by Mr. Tribhuwan Adhikari, MD and CEO. Along with him, we have Mr. Lokesh Mundra, CFO, to discuss the initial results, post which we'll open the floor for Q&A. I would request Mr. Adhikari to share his initial remarks. Over to you, sir.
Thank you, Praveen. A very good morning to all of you friends, and welcome to the post-earnings conference call of LIC Housing Finance Limited for Q2. As you are aware, we declared our Q2 financial results yesterday after the board meeting. Before I start with the highlights of Q2 results, a brief outline of some of the developments in the economy over the last quarter. The RBI, as in the October meeting, kept the repo rates unchanged at 5.5% and retained a neutral stance while upgrading growth projections, a signal that the monetary conditions are stable and supportive of credit growth. Retail inflation has moderated sharply, with the CPI printing at a multi-year low in recent months, which reinforces the RBI room to remain accommodative. On the housing front, we have witnessed a good resilient demand in Q2 as compared to Q1, which was slightly muted. For this, it translates into an environment of sustained demand and improved asset quality dynamics and good opportunities to grow the market share while maintaining credit discipline in Q3 and Q4, which are traditionally the strong quarters for the company. With that as an overview, I'd like to share the key financial highlights for the quarter. Total revenue from operations were at 7163 crores as against 6926 crores for the corresponding quarter of the previous year, up by 3%. Outstanding loan portfolio stood at 3,11,816 crores at the end of the quarter, as against 2,94,588 crores as on the same period last year, reflecting a growth of 6%. Out of this, the individual housing loan portfolio stood at 2,64,096 crores as against 2,50,879 crores, up by 5%. The housing loan portfolio incidentally constitutes 85% of the total portfolio. Total disbursements for the quarter were at 16,313 crores as against 16,476 crores for the corresponding period. Out of this, disbursements in the individual home loan segment were up by 13,490 crores as against 13,051 crores, up by 3% YOY. Sequentially, the disbursements were up by 24% as against the Q1 number of 13,116 crores. Disbursements in the project loans were muted at 378 crores as against 1,397 crores for the same period of the previous year. The overall project loan portfolio now stands at about 3% of the overall portfolio. We continue to be cautious and selective in our approach in this segment. Net interest income stood at 2,038 crores as against 1,974 crores for the same period in the previous year, and 2,066 crores for Q1 of financial year 26. Net interest margins for Q2 financial year 26 stood at 2.62% as against 2.71% of Q2 of FY25 and 2.68% of FY26. PBT, profit before tax, for the quarter was at 1,704.71 crores as against 1,664.36 crores in Q2 of financial year 25, a growth of 2%. As compared to Q1, the PBT recorded an increase of 0.32% from 1699.16 to 1704.71 crores. Profit after tax for the quarter stood at 1353.87 crores as against 1328.89 crores for the same period in the previous year, a growth of 2%. In terms of asset quality, Stage 3 exposure at default as on 30th September 25 stood at 2.51% as against 3.06% as on September 30th of last year. Total provisions as of 30th September of current year stood at 5,074 crores, reflecting a provision coverage ratio of above 53% as against a provision coverage ratio of 49% as at the end of the quarter last year. A technical write-off of 133 crores has been made during the quarter. These loans were all carrying 100% provision. Also, there was a recovery from written off loans to the tune of 83 crores. In the coming months and quarters, we expect the asset quality to improve further and this trend to continue. On the funding side, the cost of funds stood at 7.42% as on 30th September of the current fiscal, as compared to 7.73% as on 30th September last year and 7.50% as on 30th June of last year, a decline of 8 basis points sequentially against the entire borrowing pool of 2.72 lakh crores. Incremental cost of funds stood at 6.73% for Q2FY26 as against 7.71% for the corresponding period last year and 6.97% for Q1 of the current fiscal. That is a decline of 24% sequentially in incremental cost. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mehruk Ajtania from Nomura. Please go ahead.
Yeah, hello, sir.
Good morning.
Good morning, sir. Hello. So I just had a few questions. Firstly, on growth, right? So our growth is flat QOQ, when in general seasonality should be better this quarter. And the repayment in core retail also looks on the higher side. So possibly there are BT outs. How do we plug that? How do we accelerate growth from here on? Because it's just stuck on a year-on-year basis also in that single digit range. So what will how do we view growth going forward? That's the first question. Especially even in core retail. I'm not even talking about developer or LAP.
Okay. Is that the only question, Meru?
No, I have one more. So also in terms of credit costs, so now we see them settling at in this 20-22 basis points range. Is that the right way to look at it? Of course, and if and when recoveries come, then that's an additional upside. So will it be in that range, the credit cost, or would it be slightly higher or lower?
Okay, fine, Meru. I'll take your first question on growth. Yes, I do agree that the growth has been, I would say, flat, as you said. We are just showing a growth of 5%, 6% Y on Y, and Q and Q also. There's not too much of a growth. Yes, you are right. The growth to some extent has been hit by BT during this second quarter. If I take on Q2, the BT has been to the tune of 4,014 crores against a normal run rate of about 2,000 crores in a quarter, right? So in Q1 it was 2,195 crores. So there was a slight pressure on BT, largely because of, I would say, the rates. The banks are, and in case of a BT, what usually happens when a person goes out, he gets renewed the normal lending rate which is available, which is roughly which starts from 7.50 by and large in the industry. So that was one of the reasons. Yes, we were aware of this. We waiting and watching that what would be the impact, and this 4,000 crores of BT out in the quarter did sort of take away about 2,000 crores of business from our loan book. So had we decided to lower our what you call the rewriting rates, we could have probably saved on this 2,000 crores. But then again, as I said in the beginning of the year, this year is going to be a year of challenges in the sense of sort of balancing growth with the spreads and the NIMs. So we did, I would say, decide not to be very aggressive on reducing rates, as a result of it, which probably took a hit. But we have done it now very recently. We have reduced our re-rating rates to some extent. And we are hopeful that this BT challenge is now over. The BT challenge is now over, as witnessed in the month of October of Q3. The BT is at lower levels as compared to July, August, and September of Q1. So the BT challenge is over, yes. The other part is, of course, we have to grow the disbursements. The disbursements, though quarter on quarter, have grown by about 24%. But year on year, their disbursements are up just by 3%. But again, the quarter and quarter growth of 24% gives us hope that we will do much better in Q3 and Q4. And traditionally, for LICHFL, Q3 and Q4 have been the most productive quarters when compared to Q1 and Q2. So we had in the beginning of the year given you a guidance of about a 10% growth, both in disbursements as well as the book. We right now stand at 6%. So we are hopeful that the green shoots we see in the increase in disbursements from Q1 and Q2 will continue further, accelerate further, and probably by the end of the year we'll be closer to the guided figure of double-digit growth. As regards credit cost, yes, in the beginning of the year we had given a guidance of keeping credit costs within 15 basis points. Right now in Q1 it was 6 basis points, in Q2 it is 5 basis points, so together 11 basis points. But if you see, though our asset quality has been improving, we have been making a slightly higher provision. Our PCR currently stands at 53%, whereas at the end of last year it was at 49, and in the last quarter it was 51. And that is partly because of some of the, let me call it the principal, or let me say what we call is, we have something called the management overlay, though traditionally it means it is at the discretion of the management to decide how much to provide and how much not to provide. But here in this company, we have formulated this, or we have had a written down 6-point formula on what are the management overlays we are going to provide for. So there's not too much of a, I would say, management discretion on that. And because of that, some of the stressed loans which are outstanding for a longer period of time, even though as per the ECL we did not require to provide for them, but as per the formula we have fixed for ourselves, we had to provide for a little bit more. So the management overlay has been additionally provided in the quarter, which has resulted in a better PCR, or a bigger PCR, by an increase in the PCR by 2%. So probably that was one of the reasons why our credit cost appears to be slightly higher. But going forward, I believe we have made whatever provisions are required to be made. The asset quality is improving quarter on quarter. A lot of efforts have been taken place to get these recoveries, especially the legacy loans, which form a major portion of our Stage 3 portfolio, to get these resolved either through legal methods, SARFAESI, or through the NCLT, or through the DRTs, and also through conciliation, negotiation, and settlement. We expect in the remaining 2 quarters, Q3 and Q4, at least 3 big loans to be settled. They're very close to resolution. The almost literally, I would say, the final stages of resolution. The final small formalities and modalities need to be worked out. So going forward, I'm pretty sure the, I would say, credit costs would be further reduced, and I think we would be able to achieve the guided range of 50 basis points, which we had alluded to in the beginning of the year.
Got it, sir. So, but what is the new rewriting rate now that you've adopted now?
Well, it is the lending rate plus 50 basis points, by and large. Of course,
so what would it be?
The lending rate is about 750, so 50 basis points would mean closer to it.
Okay. So there's still a difference with banks, but it's lower than earlier, so it's helping business. That's correct?
Yeah, it will help BT out. It will help in containing and reducing BT out. Yes, of course, We are at a very peculiar situation. The portfolio we deal in and the segments we deal in are exactly the same ones which banks are lending to. And banks, since everything is repo rate dependent and banks are very aggressive also, their rewriting rate, for them, any BT in gets written at the normal lending rate of approximately around about 7.5, 7.6%. It will be difficult for us to match that. We cannot go so far low. But yes, we have taken a conscious call that yes, we need to be competitive. We need to somewhat put the brakes on the BT out, which were slightly at elevated levels in Q2. And the October results tell us that yes, I think we have been successful. We are now back to normal.
Okay, sir. Thank you. Thanks a lot.
Thank you. The next question comes from the line of Renish from ICICI Bank. Please go ahead.
Yeah, hi sir. Just two things from my side. One on the hi sir. So just two things. One on the NIM. So from last two quarters, we saw a significant reduction in incremental cost of borrowing, and I do understand that it will not reflect in NIM immediately. But just wanted to check, when do you see the book cost coming down materially and drive NIM higher? And also, does your PLR is directly linked to your book cost? Because in that case, NIM will structurally remain low. As the moment your book cost comes down, next quarter you have to adjust your PLR, and which will result in asset yield compression. So how do you see the NIM trajectory in near term, say next 4 to 6 quarters?
Yeah. Right now the NIMs are at 2.62% for the quarter, right?
Correct,
and in the beginning of the year, we had given a guidance that NIMs would be in the range of 2.6 to 2.8. Now, as regards the transmission of the lowering of the PLR, we lowered the PLR in the month of April. 1/3 of my book, that means out of 15 lakh loan portfolio, number of loans, 15 lakh loans, lakhs were on monthly reset. So they got reset from the 1st of April itself. The rest 2/3, that means 10 lakh loans, got reset from the first day of the next quarter because they were on quarterly reset. So the entire reset happened on these 10 lakh loans happened on the 1st of July. So the full impact of the PLR reduction was felt in quarter 2 because the reset happened from the 1st of July on the remaining 2/3 of the portfolio. So I think as far as the reset is concerned, all loans have been reset. There are no further resets which are going to take place. So I believe this 2.62 NIM, which we are seeing at the end of Q2, is the bottom that we have seen. I do not see any reason why there should be any compression on NIMs any further. Going further, as the cost of borrowing decreases, now as far as the cost of borrowing is concerned, my borrowing book of 2,70,000 crores is divided into two parts. 53% of my book, the borrowing is at fixed cost in the form of NCDs. So that is not going to get repaid. That will only happen when the NCDs go out of my books. 43% of my book is linked to the repo. These are basically bank borrowings, where I do get the benefit of reduced repo rates. So this, I would say, compression in the cost of borrowing, part of it has come into Q2, and a little bit more will be transmitted in Q3. So we can expect the incremental and the cumulative cost of borrowing. The incremental cost of borrowing right now stands at 6.85, and the cumulative cost of borrowing stands at 7.42. We expect, of course, there has been a compression, but we expect it to compress a little bit more further, probably by 5 or 6 basis points further in Q2. So that will also translate into a better NIM, I would say, in adding to the NIM. So going forward, I believe the NIMs, the range which we had given 2.6 to 2.8, we shall be maintaining it. 2.62, I believe, is the bottom of the curve, which we are experiencing right now at the end of Q2. Going forward, I expect the NIMs to improve slightly.
Got it. So, yeah.
Lokesh Mundra, CFO, I just want to add something though. So, last quarter, as on 30th June, our cumulative cost of borrowing was 7.50. Now it has come down to 7.42. So there is a reduction of almost 8 basis points. If you compare the quarterly basis, the last quarter,
For the last quarter, incremental cost of borrowing was 6.9, which has come down to 6.73. So there is a reduction of 24 basis. And this year, almost 15,000 crores, 14 to 15,000 crore entities are going to be repriced by end of March. So we are expecting a 10 to 12 BPS further cut in our cumulative cost of borrowing.
Got it. So, okay, just to follow up on that, I mean, the moment your cost of borrowing comes down, how often you sort of reassess the PLR rate? I mean, is it quarterly, 6 monthly? How is it?
Review is on periodical basis. Our PLR is repriced based on our cost of borrowing and other factors. Quarterly.
Okay.
So quarterly basis we review it.
Sorry, sir. I didn't hear that. On quarterly basis, you said?
We review it on quarterly basis, and PLR, after reviewing, if the cut is required, and it all depends on the cost of borrowing and other factors.
Got it. And my second question is again on the growth side. So honestly, our growth is one of the lowest in prime housing, despite such a strong brand and competitive pricing. And also, I'm just referring to your slide number 12, wherein the ticket size is increasing, and however, even growth continue to remain low single digits, which means login must have been lower in recent past. So, what are the plans to accelerate logins and eventually see the disbursement? And also, do you feel is there any need for a structural change? We are doing a business, considering the interest competition. I mean, do you feel there should be any incentive or a branch structures to change to sort of accelerate disbursement?
Yeah, Ravish, coming to growth, yes, that is I believe, the biggest point of worry for us as management also. As a company, I have stagnated over quarters, but I believe over the last few years, the kind of growth we envisaged or thought about has not come about. Yes, there is a lot of soul searching going on within the company. What do we do? What do we do with the distribution model? Is there something done in the distribution model? Is there something to do with the structure of the company? And towards that, the board has guided us, or board has asked us to go in for a comprehensive relook at the entire structuring of the company in terms of the offices, the locations, also in terms of the distribution channels, and what we need to do. And we are right now in the process of boarding a consultant for this process. So probably 3 to 6 months, we will be going through this entire exercise in conjunction with the board, and having a look at the overall picture and seeing that what are the areas which are holding us back, which are the areas where we need some restructuring, some change, some slight tweaking, or a major rehaul overall. So that is the process we are going through.
Got it.
For the current financial year, if you may ask me, two issues which we need to address directly. See, we are a company which is overtly dependent on agency business, right? About almost 87% of my business is through agents. As you know, these are not tied agents in the sense they are not tied to our company alone. They are freelancers and they have to do business with other companies and other lending institutions. So the question is, how do we sort of get more business out them, or rather, how do we increase their productivity? How do we make sure that the businesses which they are diverting to other companies comes to us and this and that? That would include, of course, one is the cost factor and the rates, and of course the other part of it is the tax and various other formalities which are also associated with it. So that we are doing. And the other part of it, we are also trying to develop an alternate channel. In fact, we are working on 2 alternate channels. One is the lead business. This was a business which we were not very much focused on. We started off last year, and the whole of last year we did about 800 crores of business through this channel. This is a direct business channel. We get leads through various sources, online and offline. Now these lines are funneled or aggregated together and pushed down the chain to our operating officers, who then follow up on these leads and convert them into business. Last year we did 800 crores through this lead channel, as we call it. This year we have already crossed 750 crores in H1, which augurs well for us. Target for this year is 2,000 crores through the lead channel. So this is another channel which we have to nurture, and we see a lot of potential and scope in this channel. It helps me also because it reduces my the cost also, because I don't have to pay commission to the agents. So this is a cost neutral channel. So that, and the other, we also have a subsidiary called LICHFL FSL, Financial Services Limited. It is a subsidiary of LICHFL, which was formed basically for doing sort of housing loan business and other businesses like general insurance, life insurance. It was more modeled on the structure of HDB, the housing HDFC sales channel. So that is right now contributing to 10% of my business. We are strengthening their channel. We are after them. We are asking them to go in for further recruitments and increasing their marketing force. Here we are looking at getting 15% of our total business to come from the FSL. And going forward in the next years, we want them to contribute at least 25% of our business. So these are what we are doing. The retail front, quarter on quarter, yes, there is a 24% growth in the business, Q1 to Q2. So that these green shoots gives us hope that Q3 and Q4, which are traditionally strong quarters for LICHFL, we will see better growth in Q3 and Q4. The only worry is the construction finance or the project finance channel, if I may call it, where the performance has been very, very muted this year, as against 1,397 crores in H1 of last year. We have only been able to do 156 crores for H1 of the current fiscal. So there's a big dent of almost about 900 crores there, 800, 900 crores there. But yes, this is, as we said, we continue to be cautious and selective in our approach to this construction finance segment. But yes, we have a strong pipeline of undisbursed sanctions, which will be coming forward in Q4. So hopefully this channel contributed about 4,000 crores of business last year, the construction finance channel. This year we are hopeful we are going to surpass this, not by much, but we are targeting at least 5,000 crores of business from the construction finance channel this year, which would come majorly in Q3 and Q4. So that is the guideline of the
Got it.
And Ramesh, silver lining is that the last year in the same quarter, the average yield on the project finance was 10.35%. So it has increased to almost 12.68%. So there is a increase of almost more than 200 BPS in the project finance yield. So we are taking selective call on case-to-case basis. That is why our margins are intact. We are focusing more on margins.
Got it. No, thank you very much, sir, for the detailed answer, and best of luck, sir.
Thank you.
Thank you. The next question comes from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, hi. So again, just harping on this question of PLR. So the last cut was in April, and thereafter we have seen rate actions in terms of the repo, and we are seeing the incremental cost of borrowings also coming off, like almost 16 odd basis points, maybe 24 basis points this quarter itself. So would we be revising the PLR, or maybe we are good enough with the rewriting rates, new rewriting rates, and there is no need to change the PLR at this juncture because we want to protect the margins?
Yeah, Kunal, yeah. At the beginning of the year, I said this year is going to be a difficult year for us because we would be required to balance our growth of books, growth of disbursement with the NIM and the spreads, right? So this is what we had said in the beginning of the year. And I'd also said that push through the wall, I would prefer to protect my margins and NIMs rather than going for growth of business at which is not very profitable to the company. We have been doing that. Yes, we have cut our overall PLR by 25 basis points across the board. You may say this is less when compared to the 100 basis point cut in the repo rate, but then the repo rate transmission does take time. Yes, 24 basis points incremental cost of borrowing has gone on by 24 basis points quarter on quarter, and about 90 basis points from the beginning from year on year. So the full transmission has not been felt. And going forward, as I said, we would like to protect our margins. And as while answering to Ramesh, I had said my construction finance portfolio is down this year, almost 900 crores deficit. But again, that is a conscious call we have taken. Banks are very aggressive on this front. They are giving construction finance loans almost at home loan rates, which we are not comfortable doing. We would like to have some margins in the project and the construction finance business, as CFO said. The margins in the CF business are almost what our yields are almost 12.5%. Right? These have gone up from almost 11% of last year. So yes, we would like to do business, but definitely we would like to do profitable business. So going forward, I do not, until unless something drastic happens on the repo rate front in probably December or something of that sort, I do not see any scope for any further reduction in rates. Also considering that we have very recently in the last month, in the month of October only, we have sort of reduced our rewriting rates quite significantly, almost by 75 basis points. Our early rewriting was at a flat 8.75. Now we are offering them at the lending rate plus 50 basis points, which roughly translates to 8%. So given these two reductions in the rewriting rate and the overall PLR, I do not see any scope for any further reductions.
Got it. Perfect. And secondly, when we look at it in terms of the overall BT out of 4,000 odd crores, what was the request that had come in and how much we have been able to retain, and finally we saw this BT out of 4,000 crores?
I don't have the figures, Kunal, honestly. Yeah, what total number of applications received, how much did we retain, and how much went out? I don't have the figure exactly with me. That can be found out. But yeah, overall the BT out.
Just wanted to get the sense, since you mentioned like now it will be much controlled with this newer rewriting rates. So just wanted to ensure that maybe was maximum the BT out was already there, and maybe now you would be able to retain some part of it, and that's giving you the confidence.
Definitely, Kunal. Exactly, right. Because at 8.75, even if we had tried to retain, and I don't think we could have made much of an impact when banks were offering at 7.5. It is difficult to retain a customer at 8.75. That you would also allude to. But with the reduction in BT rates, we have seen it in October. Our BT out has reduced significantly when compared to July or August or even September. And I think at 8% roughly, we should be able to retain much more as compared to what went out. See, normally our run rate was about 2,000 crores per quarter. Yeah, so and in the last quarter it was 4,000 crores. So straight away, meaning that our BT out had doubled. So I lost almost about 2,000 crores. Okay, out of these 2,000 crores, even if I assume that 500 crores would have would have gone. At least a dent of 1,500 crores definitely because of higher rates would have taken place. So probably my book would have grown by 1,500 crores more had I lowered my rewriting rates at the beginning of last quarter. So I think that rewriting rates reduction has taken place, and Q3 I am expecting the BT to come down to normal at 2,000 rupees per quarter. I expect that to be at that levels.
Got it. And lastly, in terms of the improvement in GS3 and GS2, is this largely retail because of this focused collection style which was there post Q1, or there is some element of corporate recoveries in this improvement in GS3, GS2?
Yeah. As the asset quality has been improving quarter and quarter, past 4-5 quarters almost. Yes. And this is, see, if you understand the recovery thing is not that I do something this month and I get results next month. Especially if you look at our entire book, most of the stage 3 is pertaining to our legacy loans, a particular period 2016 to 2019. And some of these loans, about 10-12 of these loans are big loans, 200 crores and above. So it does take time, especially the legal process. As you know, in India, it takes time, whether it be the SARFAESI method or whether NCLT or DRTs, these all things take time. So this is a continuous process which has been going on, and the improvement in the asset quality which you see is the result of what has happened probably 3 quarters back or 4 quarters back. So there is no easing on the pressure. We are increasing the pressure, in fact. There is another thing which we have not done so far is there is this willful defaulter guidelines issued by RBI. We have not yet initiated this, but for the, I would say, very obstinate and tough people who are not willing to negotiate, not willing to settle, not willing to talk, I think we need to initiate the process of declaring them willful defaulters and all. That is basically to put on pressure. So going forward, I feel this recovery from NPA will improve. In this quarter, if I see as compared to the June quarter, my stage 3 has come down by 742 crores. So recoveries are happening. Going forward, I am hopeful that 2 to 3 big loans, and when I say big loans, I mean 200 crores and above, 2-3 big loans to be settled. They are very close or almost on the verge of settlement or final agreement between us and the borrower. One is in NCLT. We are expecting a decision any day now, the next 14-15 days. So these will all help us in improving the asset quality and reducing the credit costs.
Got it. No, I was just asking that this quarter also, was there any resolution or no? In stage 2 and stage 3, the improvement, was it from the corporate or it was from retail?
No, it was both. Corporate, I think there was one big loan of about 40 crores which got resolved, but the entire thing did not come. I think we got about 60 crores of that. The rest is because it is scheduled, I would say, repayment. The rest of it would come in Q3 and Q4.
Okay, so this was in stage 3?
Stage 3.
Got it. Perfect. So only 60 crores in stage 3 from the corporate, otherwise balance was largely from retail.
Yeah.
Okay, perfect. Yeah. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address the questions from all the participants in the conference call, we request you to kindly limit your questions to per participant. Should you have a follow-up question, please rejoin the queue again. The next question comes from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good afternoon, sir. Thank you for taking my question. And so before I do that, may I request the operator that the operator lines and the participant lines are coming great, but the management line, at least for me, is not very great. I don't know about the other participants.
Okay, I'll try to come closer to the phone and speak so that you can hear me loud and clear.
It's a little better now. Yes, sir. It's a little better now. So, sir, just 2 questions. First thing is, just a clarification. In terms of this PLR changes that we have done, total until now, right, since the time the repo rate cuts have started, how much PLR cut have you taken? Is it 25 basis points or cumulatively 50 basis points? One 25 basis points effective from 1st April and the other one was 28 April thereabouts, is it? Just a clarification on that front.
Okay, Abhijit, we have made only we have changed the PLR only once. That was in the month of April, where we reduced the PLR by 25 basis points, right? So there's been only one PLR cut of 25 basis points. Now, what has happened that my book is divided into 2 parts. There are about 1/3 of my loans, almost 5 lakh loans, which are on monthly resets. So 5 lakh loans the PLR got reset from the 1st of April. The moment I declared my PLR cut, they immediately got repriced, 1/3 of my book. 2/3 of my book is on quarterly reset. That means the PLR reset happens on the first day of the next quarter. Since the cut was somewhere in the mid of April, the PLR got repriced from the 1st of July. So almost 10 lakh loans got repriced from the 1st of July. So right now, 100% of my book has been repriced by 25 basis points.
Got it, sir. So logically speaking, I mean, given that the entire back book has been reset, now what we are going to see is yields might stabilize till the time you take your next PLR cut, and cost of borrowing should keep improving.
Yeah, cost of borrowing should improve. Transmission, the cost of borrowing should improve further. So expecting that another 10 basis points reduction in the cost of borrowing by the end of the year.
Got it. And so then my second question was, if I look at LIC Housing as a franchise for almost this decade from maybe 2012 to 2022, we used to operate at lower margins, still deliver respectable ROAs, and because of that growth which was there and which used to give you leverage in the balance sheet, we still used to deliver very respectable ROEs. So essentially, I mean, we were still delivering growth and healthy profitability. Right now, I mean, I'm sure, I mean, early in the call, you have made it very clear that we will prioritize profitability over growth. But can't we kind of do some trade-off in terms of margins to maybe at least get to a respectable double-digit growth? Because sir, when I look at it, right, since maybe 2020, the company has not been able to get to a double-digit growth. I appreciate the fact that it's a much bigger franchise now, so growing at the same rate might not be possible. But I mean, you would have seen, right? I mean, all the participants who have participated on the call today, I mean, all of them have been asking about what steps can be taken to spur growth. And lastly, sir, the data keeping question, you usually share the segment-wise stage 3 on the earnings call. If you can also share that with us. Thank you so much.
Yeah, Abhijit, agreed. As I said during my reply to Ramesh and others, this is one question which has been bothering me, growth. Yes, I do agree to what you're saying, that we are a big company, 3 lakh crores of AUM, so definitely expecting me to grow at the same rate as some of the smaller companies is not possible. But definitely this growth of 7% or 8%, whatever we call it, not acceptable at all. This is the biggest question which is worrying me, which is worrying the board as to how do we grow. One of the methods, I would say slightly what I call it the inorganic method, is probably going for co-lending or direct assignment. This is something which we have not at all tried in the past. All our business is totally what we directly source, either from agents or through direct business or whatever. So definitely there is a scope for getting into co-lending arrangements, into going in for direct lending or direct assignment, which can also boost my book. Yes, that is something which we are exploring. Right now, we are framing a co-lending and a direct assignment policy, which we will get approved by the board. The board also agrees that yes, we need to have a policy and need to explore this particular channel of growing the book. So probably that is one method which we need to deploy or employ, if you may call it. Yes, definitely. And the other thing, as I said, I think we really need to have a relook at the organizational structure we have, the various marketing verticals we have. Do we need any change? Because something is sort of pulling us back, not allowing us to go. Because one thing is for certain, I will not say that there is no demand for housing loan. There is definitely a demand for housing loan. It is only going to grow as I see it. It is only going to grow as the economy grows and the sentiments turn positive. So definitely we really need to do something about it. Yes, this year also I do not say that we are going to do something exponential in the remaining 2 quarters. We will be very happy to achieve a double-digit growth both in the disbursement and in the book by the end of March. And traditionally, quarter 3 and quarter 4 are good quarters for us. Last year it was slightly subdued because of certain problems in Bangalore and Hyderabad, two of our major contributors, two of the major regions contributing to our business. So this year both these regions are back on track. So this year definitely these two regions will contribute much more as compared to Q3 in last year and partly Q4 of last year. So there will be growth, 24% growth from quarter on quarter. We want this growth to go up further. So hopefully there will be growth in business, but again, even a double-digit growth I don't think would satisfy me. We need to look at ways and means of coming to somewhere around probably 13%, 14%. And I think that is doable with a little bit of structural changes, probably some more rethinking, relook, more brainstorming at the corporate level and pushing it down the line. So we are engaged, we are worried, and hopefully we will be able to turn on the corner in probably 1 or 2 years.
Got it. So, and then if you could just share those segment-wise states too.
Yeah, segment-wise, yeah. No, you want it separately for IHL, etc.?
Yes, sir.
Just a minute. What is this?
Abhishek, you want provision figure?
No, sir. So if you could share both, one is the states for IHL, NHL, and project loans.
For individual, it is 1.15% only.
Okay.
Project, it is project plus non-housing corporate, so it's 24.88%. And non-housing individual, it is 4% only. And totality is it's 2.51% of the total portfolio.
And sir, what did you say about non-housing individual?
Non-housing individual only. Non-housing individual, right now we don't have breakup of non-housing individuals. Let's say, just let me check it.
So you said the number. One was IHL 1.15, project plus non-housing commercial, which is 22.88. And then you said the third number, which was non-housing individual.
Non-housing individual, 4%.
4%. Okay. Thank you so much. That's all from my side. And I said I wish you and your team the very best.
Thank you, Abhijit.
Thank you. The next question comes from the line of Prithviraj Patil from Investec. Please go ahead.
Hi, thanks for the opportunity. So my question was, what is the incremental yield that we are seeing in the business? Yeah, sorry. What is the incremental? Yeah, if you can hear me. Hello, am I audible?
Yes,
hello?
sir. Please proceed.
Yeah, please go on.
Yeah. So what is the incremental yield for the new disbursements?
Incremental yield for this first half, it is 8.78%. And 8.78% incremental yield as on 30th September 25.
Okay. Thank you.
Thank you. The next call comes from the line of Shweta from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So just to close the argument on PLR front, so now given the fact that larger part of the book is priced at 8% levels, so these are the comfortable levels for you wherein you're confident that BT outs will be restricted and therefore no further PLR tweaks are required. So is this my understanding correct?
Yeah, we have repriced both our existing book as well as the rewriting rates. Right, the existing book is repriced by 25 basis points, and our rewriting rates, which were at a flat 8.75%, have been repriced to 50 basis points above the fresh lending rate. So roughly around about 8%. I do not say that this will result in no BT out. Because again, BT out, see, if you see the biggest problems in BT out, when loan goes out of my book, it enters the other institution as a fresh loan. And naturally, the fresh loan rates are lower than the existing loan rates. So, for example, if I take, supposing a loan goes out from my book to State Bank of India, the lending rates at State Bank start at 7.5. So probably he would be getting the loan repriced at probably 7.6 or 7.7, whereas my repricing is at 8%. So there could be some customers who would go out because of this 20 basis point difference or 25 basis point difference. But by and large, I think customers are not so, I would say, sticky on 20, 25 basis point difference if their experience has been good in the existing company. So but I'm pretty sure that this huge uptick in the BT out, doubling of the BT out, if I may say, because as I said, the average run rate was 2,000 crores, and in Q2 we witnessed a run rate of 4,000 crores. So this doubling of the BT out will not happen. We expect this to come down to either the original levels of 2,000 crores or even further, probably to 1,200, 1,500 crores level.
Shweta, our rates for the new business is very competitive, and it's matching with the other financial institutions like bank and other HFCs. So, if what sir is, what MD is giving the example, if the customer is having a similar score is offered 7.50, so if other institutions are offering a 7.50 or 7.65, what sir is saying, but definitely there is some documentation cost, and that documentation cost is almost 40 to 50 BPS. In that case, suppose 7.5 and our rewriting rate is just 50 BPS above the fresh lending rate, so it's a matching only. So I don't think our business will transfer out. Definitely, we are very confident that in this quarter, this BT will be arrested.
Fair point, sir. The second question I had in terms of ECL, so when is the annual reset exercise for us as far as ECL is concerned, and what is the period of consideration for us for those PD, LGD calculations? Thank you.
No, Shweta, PD and LGD is done on a quarterly basis, right? Every quarter we run the ECL model, and our PD LGD is calculated on a 10-year database. So, for example, if I take the September quarter, so September quarter 2025, that means the assessment of PD and LGD would be on business done from the 1st of October 2000 and minus 25 minus 10 means 15. From the 1st of October 2015 to the 30th of September 2025. So every quarter, 3 months would go out and 3 new months would be added to calculate PD and LGD. And what was the first part of your question?
So when is the ECL reset exercise that happens?
ECL reset. Can you just explain that?
So how many months you consider for calculating the expected credit loss? Like backwards and ahead, what are the periods into consideration for calculating the expected credit loss?
As I said, PD LGD is on a 10-year. From the end of the quarter, 10 years back we go. And all loans pertaining to those last 10 years are taken, and based on their experiences, the PD and LGD is calculated. And the ECL is based on the PD and LGD. The ECL is calculated on the current loan book. Does that satisfy you?
Yeah, you answered the question by mentioning 10-year period. Got it, sir. Thank you.
Thank you. The next question comes from the line of Kushagra Goel from CLSA. Please go ahead.
Sure. Hi. Thank you for taking my question. Most of the questions are...
I'm so sorry to interrupt in between, sir. Your voice is not audible.
You need to be a little...
Yeah. Is this better?
Yeah, yes, sir. Please proceed.
Hi. Thank you for taking my question. Just, sir, could you give some more color on the competitive intensity? So I know we have talked a lot about growth, but if you could just talk about more how how you see the PSU banks behaving going forward. So that would be helpful. And secondly, if you could give some more color that I know we are not reducing PLR and all the impact is there, but can the incremental yields come down further from current levels? How should we think about it?
Yeah, Kushagra, right. As regards what PSB banks are going to do, I don't know. I do not know whether I can take a call on that. Yeah, but one thing definitely, PSB banks are very, very, very aggressive right at the moment. I do not know why the aggressiveness has come about. Is it something to do with reducing their unsecured lending portfolio? Because housing finance, as you know, is a 100% secured portfolio backed by solid collaterals. But yes, what we are seeing is PSU banks are very, very aggressive, right? Offering rates as low as 7.35. At least two banks I know offering new loans at 7.35, whereas most of the bigger banks, PSU banks, are at 7.5, where we are exactly right now. So I believe we are competitive as far as that is concerned, insofar as that is concerned. So yes, and unfortunately, we're a housing finance company. We're not a bank. But the segment we operate in, if you look at my book, it is almost 85% salaried and probably 10% self-employed and another 5% to the non-housing corporates, etc. So the segment we operate in is exactly the segment in which the banks are operating. So quite naturally, there's a lot of competition, there's a lot of pressure, and banks are very, very aggressive, as I said. Even in the construction finance book, which we are not doing very well at the moment, banks are very aggressive in the construction finance space also. There are cases which have come to me where PSUs have offered rates which are almost at par with the individual lending rates, and these are the rates being offered to construction finance companies, which we are not very comfortable with. We would not do. So yes, the competition is intense. The competition is quite aggressive. Nothing we can do right now. Overnight, it is not going to change. I cannot ask my people to stop selling to salaried customers and totally focus on the self-employed. Yes, we are trying to change. We are trying to change our product mix so that we are a little more, I would say, focused on the self-employed segment. And the other segment, as I said, affordable, we explored it last year. We are very, very slow, cautious on that segment. We are growing the book, but very, very slow pace, and we are comfortable with that. We don't want to take an aggressive stand on that and enter into problems. We are first trying to set up a new team, completely separate team for the affordable segment, something like what PNB has done for its Roshni vertical. It will take 2-3 years' time. I do understand that. But yes, at the moment, competition from the public sector is very, very intense. And the other part, what was the second question, Kushagra? I just forgot.
Sure. So that was on the incremental yield.
Yeah, the incremental yield.
Kushagra, yeah. So incremental yield for this H1, that is 8.78. So we don't see any downside in yield part. But on the other side, on the cost of incremental cost of borrowing, definitely we are expecting 10 to 12 BPS downside. So definitely our spread would be in line with our expectations.
Okay, sir. Got it. That's all. And best of luck.
Thank you.
Thank you. The next question comes from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Good afternoon, sir. Most of my questions are answered, but just two things. First, on the borrowing side, this borrowing which you sourced in Q2 at 6.73%. Can you tell us the mix? And also, can you tell us the fresh pricing for NCDs for bank loans and whether the whole repo benefits on the bank loans, on the existing bank loans has already come through?
Yeah. So, Rajesh, our borrowing structure is almost 55% is fixed, what we have raised through NCDs, and almost 45% is floating. So whatever we have raised funds at floating rates, mostly from the banks only. And And total average borrowing cost is 7.42. And this year, definitely we are focusing more borrowing through banks only. And this quarter, almost 92%, 93% we have borrowed from banks.
Okay. Okay. But can you just quote the fresh bank loan pricing? I mean, is it below 7 and how much it is for the new facility that you would have taken from banks? And similarly, if you were to also raise, say, a 3-year, 39 months NCDs in the market right now, what will be the cost of NCDs?
Yeah, so banks, this quarter we have borrowed banks between 6.75 to 6.90, in between 6.75 to 90. And NCDs we have raised around 6.89 to 6.90.
Okay. And just one last thing, in terms of new home loan pricing, which I think we last reduced in June by 50 basis points. So given the fact that we want to preserve margins, even at the cost of growth, if the competition were to become more aggressive in terms of new loan pricing, we will not follow competition. That seems to be the approach. Is that understanding right?
Yeah. No, it's not a basis. Yeah, it's not 50 basis point cut. We have cut the home loan rates, or the PLR, if you may call it, by 25 basis points in the month of April. After that, there have been no PLR cuts.
No, sir. In June, I think in June you reduced the new loan pricing by 50 basis points to 7.5.
New loan, yeah, new loans.
Yeah, new loan. I'm talking about new loan. Yeah.
New loans is brought it down to by 50 basis points to be competitive with the rates being offered by the PSUs, which is at almost 7.5 by and large, and we are also at 7.5. So that is already been done. Now, assuming the same scenario continues, I do not see any scope for any further reduction in the pricing for new loans. I think we are fairly competitive enough. I don't see any. We can afford to bring it down any further. But as I said in the beginning of the year, we need to balance growth along with our spreads and margins. And given a choice, I would like to protect my spread and margins as compared to going aggressively for, I would say, non-profitable growth. So we intend to follow that same trajectory. And I think as far as I am concerned, the new loan rates are where they are, and we would like these to continue for the rest of the year, until and unless there's something majorly happening, probably in the December MPC or nearby or somewhere near that.
Got it, sir. Thank you. Best, sir.
Thank you. A reminder to all the participants that you may restrict your questions one per participant. The next question comes from the line of Bhaskar Basu from Jefferies. Please go ahead.
Good afternoon. I had two questions actually. So firstly, what would be the yield on the portfolio of home loans? You give the total portfolio yield of 9.2, but the home loan yield for the portfolio. And also just wanted to understand how does this whole rewriting thing work? Someone who's looking for a balance transfer, could you offer an 8% yields for them?
Yeah. I come to the rewriting part. Yeah, as regards the sort of yields, CFOG will answer it. Coming to the rewriting part of it, over a period of time, the loans would have been given at various rates of interest, and depending on the increase in PLR or lowering of PLR, the rates would have been reset either monthly or quarterly, and right now the customer would be standing with a particular rate of interest. Whenever he comes to us for a rewriting request, we do assess his CIBIL score, because rewriting rates are not flat 8%. They are dependent on the CIBIL score of the borrower as on date. So we will be assessing the CIBIL score and the other risk factors associated with the loan. And based on that, we would be giving him a rewriting rate at which we would rewrite his loan. Broadly speaking, the rewriting rate is at 50 basis points higher than the lending rate. The lending rate right now, lowest lending rate is 7.5. So add 50 basis points to that. So that comes to roughly 8. Does not mean that everybody gets rewritten at 8. It would also depend on his CIBIL score and other risk factors associated with it. So that is about the rewriting. And as regards the yield on the various
Bhaskar. So segment-wise yield as of 30th September 25 of our individual housing loan, it is 9.24%. and for non-housing individuals it is 10.22%, and for non-housing corporates, including project finance, it is 10.54%. The average is 9.40% for this as on 30 September 25. On incremental basis, to segment-wise, IHL is 9.03, non-housing individual is 10.21, and non-housing corporates, including projects, is 10.47.
Right. So my connected question was that, say, your overall housing portfolio is sitting at around 9.2. I understand that there will be various borrowers at different categories of CIBIL score. But this is still fairly well above your rewriting rates. So don't you see a lot of these borrowers coming for reset, or at least coming down to that 8% or whatever the rewriting rate? So my question is whether this back book continues to reprice going forward, even though you may not have another PLR cut.
For rewriting, that 8% is a minimum rate. If the customer is having the highest CIBIL score, more than 800 points, in that case we are offering at 8%. For new business, it is 7.50%. But it depends on the CIBIL score of the customer. The 8% is a minimum rate for rewriting.
That I understand. Yeah.
I do agree, yes. By reducing the rewriting rates, the question is, do we expect all people to come to us for rewriting? No, that usually doesn't happen. Because if you take the experience of Q2, out of a book of 15 lakh loans, a total of 13,715 customers took a BT, right? Transferred their loans from us to the banks. So by and large, I would say the rewriting would happen for in a quarter, about 1,500 crores of business. So it is not that my entire back book is going to get repriced because of the rewriting facility which I offer. But yes, definitely people will be coming, and anybody who is probably at say 8.5 or more than that would definitely want to reprice his loan at 8% or nearabouts.
Right. So I get it. So basically there will be some repricing which will continue, obviously not to the extent of the PLR cut, but at least a reasonable portion of your back book will continue to see some repricing.
It's a call. Rather than have 4,000 crores of business go out of my books completely, where I earn nothing, it's better to get something at 8%, given my cost of borrowing at 6.75%, earn at least 1.25% rather than nothing at all.
Understood. And just one last question. On the OPEX side, we saw a sharp decline in the employee cost. Any specific reason for that, and how should we think about sustainable and employee costs, etc.? So it was like 140 crores versus...
Oscar, last year was, let me call it, a year of wage revision and LICHSGFIN, right? The wage revision of all the employees in the company was due. So we were making provisions all through last year. Every quarter we were making provisions for this, what you can call it, the supposed increase in the salaries of the employees. So now that the wage revision has been done, the salary cost is now fixed. There is not going to be any other, there is no impending wage revision until the 1st of August 2027. So no provisioning for wage revision is being made. So that is the reason why the salary cost has come down.
But say, for example, between 1Q and 2Q, 1Q was like 160 crores, 2Q was 140 crores. So where is the kind of, how should we think about the run rate actually? Whether 1Q is a better benchmark or 2Q?
Salary cost, you have the breakup? So basically the impact of provisioning only. So I don't see any reason why, or just a minute, just give me a minute, let me get to sure. Yeah. The employee cost, the actuals for Q2FY26 was 143, right?
Yes. And 1Q was 160. So even
one was 160.
So even between 1Q to 2Q, we've seen a 20 crore drop.
I think the employee cost would remain at the current levels, I think. 143, at the most probably 150, not more. There is nothing which is going to get added to employee cost, except probably in Q4, where we do make provisioning for gratuity.
Right.
I think Q3 is going to be in the 50 crore range. Should not be 160, which what it was in Q1. It will probably be in the range of 150.
Got it.
Nothing increase my employee cost. Nothing has been done which is going to increase my employee cost. No new hirings or anything of that sort.
Got it. Thanks. That's all from my side.
Thank you. The next question comes from the line of Subramaniam Iyer from Morgan Stanley. Please go ahead.
Thanks. My questions have been answered. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for closing comments. Over to you, sir.
Yeah. Thank you. Thank you, friends, for your questions and the concerns which you have shared for the company. Yes, overall, the company is doing well on all fronts except the growth front, as all of you alluded to. And as I said during my conference call, this is something which is worrying us, not only the management, the board also. And this is something, if I may call it this, we need to get out of this trap and move forward towards an assured path of growth, which continues quarter on quarter. We are working towards that on various fronts. Q3 and Q4 traditionally are very strong quarters for the company, and going by the situation in the market at present, as far as demand is concerned, as far as all the other factors are concerned, I think are all positive. There is nothing which I see in the horizon which is going to retard our progress or stop our progress from growing aggressively in these 2 quarters. As I said, Q1 to Q2, we have seen green shoots already, especially on the retail front. 24% growth displayed in Q2 as compared to Q1. So I believe that Q3 is going to be even stronger, and going forward, the company expects to do better both on the disbursement front, the loan book front. The asset quality front is doing well progressively, and we will continue to grow progressively. The asset quality is going to improve. Provisioning requirements are going to reduce, and some big resolutions expected. Hopefully, all this put together will transform into Q3 into a much stronger quarter for LIC Housing Finance. Look forward to your assured support and cooperation. Thank you. Thank you all.
Thank you. On behalf of LIC Housing Finance, that concludes this conference. Thank you for joining us today, and you may now disconnect your lines.
Thank you very much.